In today's video, we are going to talk about rental income. More importantly, how we can retire early by investing in real estate, as well as how many properties we actually need if we want a comfortable retirement. If you have been watching my videos for a long time, then you will know that I don't really care about trying to time the market and buying the property at the bottom of the cycle and then selling at the top. And I don't really care about any short-term corrections, and there's a reason for that. And the reason for that is because I'm not trying to make some short-term profits, but instead focusing on building a good portfolio that is going to build me wealth over the long term, as well as generate enough rental income for me to retire comfortably in 20 or 30 years time. In today's video, we are going to crunch a lot of numbers, look at some historical data, as well as look at some examples to see if it is possible for us to build a portfolio that will generate enough income for us to retire comfortably. So make sure you guys watch this video to the very end if you're serious about building a property portfolio that will generate enough income for you to retire on. I'm sure you guys are going to get so much value out of this. And as always, please understand that this is not financial advice. I am simply sharing with you my personal opinion and personal strategies. I will always encourage you to do your own research and seek the help of real financial experts before jumping into any financial or investing decisions. I will start this video by identifying my goal as a real estate investor and outlining my investment plan. I simply want to use real estate as a tool to build wealth, as well as a vehicle to generate consistent passive rental income. To achieve this goal, I'm not going to focus purely on capital growth or on strong rental returns, but instead find undervalued properties that have good growth potential as well as strong rental returns. This in turn is going to build me strong equity in my portfolio, as well as generate a strong monthly cash flow, which is going to help me accelerate the process of achieving financial freedom and early retirement. I think it is very important for you to have a long-term goal and have a plan in place. This is going to help you stay on track and not get distracted by any short-term corrections or dips in the market. Now let's get straight into it and talk about the kind of property that we should be looking for. Because if we want to retire from rental income, then we're going to need a number of different things. And the most important thing is the type of property that's going to generate long-term capital growth as well as a strong rental return. 2020 was definitely an eye-opener for me, and it revealed the flaws of many investment properties and investment property types that focus purely on strong rental returns. Some examples of this are student accommodation, inner city apartments and service apartments, which are all reliant on overseas students and overseas travelers. And in the absence of this, like we saw in 2020, these type of properties performed extremely poorly. Another issue with this type of properties is the tenant turnover, which means the number and frequency of tenants moving in and out of your property is extremely high. When you have to find a new tenant every 6 or 12 months, this is going to become very costly because it means higher vacancies. Plus, your real estate agent is going to charge you an advertising fee as well as a leasing fee every time they have to repeat the process of finding a new tenant. Not to mention the body corporate fees, which can be a lot higher than you would expect. When I purchased a student accommodation back in 2015 for $120,000, the yearly body corporate fee on that tiny little property was $5,000 a year. By the way, I have since sold that property and invested the money into more productive assets, as well as the fact that these type of properties are unlikely to see any real capital growth going forward because the incredible amount of supply that is flooding the market. These fundamental flaws of these type of investment properties should be enough to discourage you from adding it to your portfolio, especially since our long-term goal here is to build wealth and generate consistent, strong rental income. So don't be fooled by the 10 or 12% rental return that you see on these properties, because once you factor in the expenses and the increased vacancies, the rental yield is going to drop to something much lower, and we can definitely find better elsewhere. So if I'm not adding these type of properties to my portfolio, what kind of properties am I adding to my portfolio? Now, if you're a long-term viewer of my channel, then you will know what I'm about to say next. I absolutely love freestanding houses in the regional and interstate markets. I love these type of properties because one, they are freestanding houses. That means I don't have to pay any body corporate or any management fees. And two, because they are freestanding houses, I get the land component, which I can then renovate to add value to the property, or if I decide to subdivide in the future, I can turn my one investment property into 2, 3, or even 4 investment properties. If you live in Sydney or Melbourne like I do, then the numbers that I'm about to tell you are going to blow your mind. If you find a nice property close to Melbourne and Sydney, then you should be expecting a rental return between 2 to 3%. And if this property is in a good neighborhood, then you will have a vacancy rate of around 3%, which is pretty damn good for these markets. However, when I look at the regional or some interstate markets, which have recently become very competitive, I can still find a rental return between 5 to 6%. That is almost double than what we expected to find in Melbourne or Sydney. And what's even better is the extremely low vacancy rates in these markets. If you look at the vacancy rate for the postcode 3556, which is where one of my investment property is located, then we will see a vacancy rate of less than 1%. Remember, the higher the vacancy rate, the more money we will lose from the property being vacant. This means properties in the Melbourne and Sydney property markets are going to provide us with lower rental returns and higher vacancies, which does not sound like a good deal at all. I don't know about you, but this is definitely not in line with my strategy. And because of that, I won't be buying in Melbourne and Sydney, but instead focusing on the regional and interstate markets, where I can find stronger rental returns, lower vacancies, and in my personal opinion, just as much capital growth as Melbourne and Sydney. Now let's move on and talk about cash flow, because when we retire, we are going to rely on cash flow to fund our lifestyle. If you have been watching my previous videos, then you will know that I'm not a big fan of negative gearing. Yes, you will definitely get some tax benefits if your property is negatively geared. However, you have to lose money first for your property to be negatively geared. I also don't like the idea of having to contribute hundreds or even thousands of dollars towards my mortgage every single month. I'd rather have my tenants pay my mortgages for me so I can focus on more important things like building extra income or making extra videos for you guys. Based on my personal opinion, after taking into consideration all the expenses such as property management fees, council rates, water rates, land tax, insurance, repair and maintenance, and the current interest rate of 2.5%, a property needs to have a rental return of at least 6% to be cash flow neutral, and anything more than that should make a cash flow positive. If we purchase a $350,000 property and put down a 20% deposit, our total loan amount, including stamp duty, will be $292,000, and we'll have a yearly repayment of just under $14,000 based on an interest rate of 2.5%. If the property has a 6% rental yield, the rental income will be $20,200, which includes a 2-year vacancy period per year. If we then minus the management fee of 8%, we will get $18,576. If we then factor in the council rates, water rates, land tax and insurance, which sums up to be around $4,000, if we then allocate $1,200 towards repairs and general maintenance for the year, we will have a net income of around $13,400, which makes this property pretty much cash flow neutral. Bear in mind, the numbers and figures shown here are based on the information I have collected from my investment properties, and these numbers are going to vary a lot based on which market and which kind of property you are investing in. So I would strongly encourage you to do some accounting and research of your own to find out your exact cash flow position so you can make better investing decisions going forward. This looks pretty promising, doesn't it? Finding a house for $350,000, putting down a 20% deposit, and then have your tenant pay off the property for you over 30 years. However, what if I told you there was another option that could be even better? Even though I would not recommend this, those with a high risk tolerance can definitely implement this strategy to start making some cash flow income from day one. If we go back to the repayments calculator and change the repayments from principal plus interest to interest only, we will see a huge drop in our monthly repayments. Even though the interest rate has increased by 0.2% from 2.49% to 2.69%, our repayments have dropped from $1,153 to $655 per month. This means even after we take into consideration all the outgoings like maintenance, repairs, insurance and other expenses, the property is still going to put $5,500 into your pockets every single year. I know this sounds like a great strategy, but the issue here is that we are not paying down our mortgage at all. So instead of having our tenants pay our mortgages for us over the 30 years, we are simply putting some surplus cash into our pockets. And our mortgage will still be what it is now in 30 years' time. It also comes with a lot of other risks, so please do your own research before implementing an interest-only strategy into your investment plan. And for your information, all of my loans are currently on principal plus interest repayments because I want to take advantage of the current record low interest rates and pay off our mortgage faster. Even though having a cash flow neutral or cash flow positive investment property sounds pretty good, there is one important issue that we must discuss. We need to understand that we are currently seeing record low interest rates, and in the long term, this interest rate is going to increase, which is going to increase the repayments, which in turn is going to make our cash flow neutral or cash flow positive investment properties become negatively geared. However, this is where economics come in. If the Australian government and the Reserve Bank of Australia decide to increase the interest rates, it will most likely be a direct response to inflation. If they think inflation in Australia is becoming too high, they are going to lift rates to restrict that inflation and bring it back down. In a perfect world, if inflation is high, it means people are out there spending money on goods and services, which in turn is driving up the price of those goods and services, and that is what inflation is. But for people to spend more money, they must first have more money to spend. This means that their wages and their income must be growing. So in a perfect world, when people are out there spending money and inflation is high, the wage growth and income growth should be higher as well, which means people can now spend more money on rent, and rents should be growing too. I know this sounds pretty confusing, so let's sum this up with one sentence. In a perfect world, when interest rates rise, income, wages, and rent should be rising too. If you don't see rents rising anytime soon, then you must live in Melbourne or Sydney. In most parts of these cities, the rental income has been stagnant for many years. However, it is a completely different story for Hobart and Perth. Hobart has had a housing shortage for many years now, and as a result, the rent and the capital values have increased dramatically over the last decade. I've seen these rent rises and capital growth firsthand because I have invested heavily into Hobart and other cities in Tasmania. The same thing is now happening in Perth. The rents in Perth have gone absolutely crazy over the last few months, and this trend is likely to continue as the city deals with major housing shortage and surging demand. This now takes us back to the first part about finding the right property. Because if we want to succeed in our journey and achieve our goals, we need to find a property that is not going to only do well in terms of capital growth, we want the rental income to increase year on year as well. Now let's put everything together so we can work out exactly how many properties we need to generate enough rental income for us to retire comfortably. Now there are a few different ways to do this. The easiest way is to build up a cash flow neutral or cash flow positive real estate portfolio consisting of as many properties as possible, and pay this off over the next 30 years so that when you retire in 30 years time, the rental income from these properties can fund your lifestyle. Using this strategy, I believe I only need 6 properties to retire comfortably. If we purchase 6 investment properties for $350,000 each, and these properties generate a rental income of 6%, we will expect to receive $400 per week from each of our investment properties, which will add up to be $2,400 per week from our entire portfolio, or $124,000 per year. But what if we went with the approach where we made our repayments interest only? Well, after 30 years, we'll have the same 6 properties, but the only difference here is that each of these properties will be giving us the same $5,500 per year of surplus cash flow, and the entire portfolio will only generate an income of $33,000 per year, which is definitely not enough for us to retire on. However, the thing with interest-only loans is that because the repayments are so much lower, this increases our borrowing capacity, meaning we can buy more properties and build up a larger portfolio. So instead of 6 properties, we could very well have 8 or even 10 properties. And this larger portfolio will have generated much more capital growth compared to the 6 property portfolio. This means that we could very well sell a few of these properties to pull out the cash and use it for our retirement. If I'm being completely honest, I've definitely become more open to the idea of interest-only loans, and I believe I will be implementing this into my investment strategy in the coming years. A property portfolio of 6, 8, or even 10 property sounds pretty damn exciting, doesn't it? But there is a catch. In order to have the borrowing capacity to buy so many properties and build such a large portfolio, we are going to have to increase our income dramatically. I covered this topic in much more detail in one of my previous videos, how to build a multi-million-dollar property portfolio. So please feel free to check that out after this video. In order to improve our income, we have to either find a higher paying job or improve our income via side hustles or other revenue streams. Either way, this is a must if we want to build up a large property portfolio and retire on that portfolio. Because if we don't, we will be stuck on our first or second investment property like 90% of investors out there. And as we can see in this graph, only 1% of investors own 6 properties or more. So if you want to join this exclusive club, we will definitely have to make some sacrifices. Knowing that we can reach a comfortable retirement with 6 investment properties, I want to know in the comment section below, what is your goal? How many properties do you plan on adding to your portfolio? Before we conclude the video, I just want to make it clear that this is not financial advice. This is simply my personal opinion and my personal strategy. I will always encourage you to do your own research and seek the help of real financial experts and make a strategy that is tailored to your circumstances and your goals. I want to thank you for watching this video till the very end. I really hope you got some value out of this. If you did, please do me a huge favor by hitting that like button and subscribe button right there and commenting your thoughts below. I would love to chat with you in the comment section below or on my Instagram at @investwithzeng. I wish you the very best of luck on your investing journey, and I will see all of you guys in the next video.